We have seen that through SIP, an investor can achieve the big goals of his life easily. We have also seen the unique characteristics and advantages which put together make it the best technique. Now we will come to how to get the maximum out of an SIP or from any mutual fund investment for that matter. We have a formula which can help the investor achieve his goals in the way he had always imagined. And the three magic ingredients of the formula are: start early, invest in the right asset class, and save regularly. Start early to get the maximum out of power of compounding. Here are two childhood friends, Mr. Gupta and Mr. Saxena. Gupta started his retirement SIP in an equity mutual fund of rupees 10,000 a month on his 25th birthday. While his friend Saxena realized a little later that he should too start investing for his retirement. So, he started his retirement SIP when they were 45. But Saxena was smart. Since Gupta was already investing since 20 years, Saxena decided to double his SIP amount, so he started investing rupees 20,000 a month. Both friends continued their respective SIPs until they turned 60. Gupta, who invested rupees 10,000 a month, invested a total of rupees 42 lakhs towards his retirement in these 35 years. And Saxena, who started late but doubled his SIP, invested a total of rupees 36 lakhs over these 15 years. On their retirement, Gupta got a whopping rupees 11.41 crores on his investment of rupees 42 lakhs. His retirement is going to be a joyride for sure. Whereas Saxena, who got in late but tried his level best by doubling the investment, got only rupees 1.23 crores on an investment of rupees 36 lakhs. The rate of return in this example is assumed at 15% per annum. Hence, we conclude that the investor should start investing as soon as he can to get the most out of compounding and get a handsome corpus when his goal arrives. Secondly, as discussed earlier, people do not achieve their goals because the cost of the goals when they arrive is higher than the investor's investment value. There is a gap between the two since inflation has pumped up the cost of the goal. So in order to achieve this goal, the investment's value also needs to be pumped up. And this is only possible when the investor invests in the right asset class. An asset class which is not just able to match inflation but also outperform it. So here are two graphs showing the growth stats of different asset classes from March 1981 until March 2018. The first graph shows the actual return generated by the asset class as well as the real return, that is, the return over and above inflation. The prices of goods and services have increased by 6.1% over these 37 years. Investors most trusted, gold, silver, fixed deposits and company deposits, all of these asset classes have been able to just beat inflation by a margin of 2 to 3% over these years. Equity is the only asset class represented by Sensex which has been able to respectfully beat inflation by a wide margin of 8.4%. Coming to the second chart, if one could buy 1 month's groceries for rupees 1,000 in the year 1981, he would need rupees 8,321 for buying the same amount of groceries in the year 2018. If this investor had not spent and had invested this rupees 1,000 in any of these asset classes back in the year 1981, then the traditional ones would have reached in the range of 17 to 27,000 as can be seen here over these 37 years. That is around 2 to 3 times the value of inflation. While the same rupees 1,000 if invested in Sensex would have been now worth more than rupees 1.5 lakhs. That is almost 19 times the value of inflation. And here we have taken Sensex to represent equity, while actually we are investing in equity mutual funds, which generate superior returns than the Sensex. So the bottom line is, bank FDs and gold won't take the investor anywhere in the goal achievement process. Equity will. The third ingredient of the formula is disciplined investing, that is, save regularly. People generally accumulate money and then invest. But in the process, A portion of money thus accumulated goes into discretionary expenses. Plus, there are also chances of buying at market highs. A super successful strategy for imbibing discipline in investing is rupee cost averaging, which we discussed earlier. And the best of rupee cost averaging is displayed in the SIP mode of investing. SIP helps the investor get over market timing. The investor automatically gets more units when the markets are low, so it captures the best investment opportunities. And his step-by-step contribution through SIP takes him towards his long-term goal achievement. Here, the investor must note that he should never miss his SIP. Missing an SIP will not give his investment the full benefit of rupee cost averaging, because the point when he missed could be a market low. Furthermore, since the SIP is meant to achieve an important life goal, each miss will drag the investor away from his goals.